Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what's going on with the Twitter world. I'm also going to get some other individuals on the channel. I think Shabam's going to come on next week. We'll see some other guys, see if they're interested in coming on. But right now we're going to go through Twitter, see what people are sharing. Obviously, I'm going to interject my financial opinions with respect to whatever we're reading. It's going to be mainly commodity-driven and financial markets. So let's dive in here. If you want to follow me, it's at finding_finance. And if you want to become part of our community, love to have you part of the community. It's finding-value.com. Again, we've got a 7 a.m. Mountain Standard Time question and answer session that you can ask questions. And I'm going to ask this weekend what you guys want for training. I can throw another training course for everybody if you're interested. So gold versus gold miners in historical perspective. Chart ruining some dreams. So what's going on here? We've got gold miners, and you can see the gold mining companies have vastly underperformed the metal itself starting in the mid to late 2000s. That's where we saw the disconnect. That is also where that XAU to gold ratio or GDX to gold ratio is showing favorable for the miners. Gold's gone up 6% per annum. We've got the miners at 2%. So they're obviously underperforming. What causes that? Well, miners are subject to inflationary inputs or just inputs in general. And then they are also subject to the price move of gold itself. So gold needs to go up at a faster pace than their input costs. And if the cost curve continues to go up and the price of the metals or the metal itself basically bounces off the cost curve, you could have an opportunity where the commodity itself outperforms the mining companies themselves. This could happen across the board if you get a large shortage of something on the mining side. It could be energy related. It could be something with the materials that are used in mining. So one of those things could increase the cost curves dramatically. And you could see the gold miners' cost curves and the price of the commodity go up at the same time, which is what I think will happen. The thing that we could get into is lower ore grades requires more and more energy. And I don't think technology can offset the declining ore grades to the extent that we want the flow of that commodity. So as flow of commodities increase, as we want more and more production of a commodity, we are going to have to mine lower and lower ore grades. And the grades at some point will be so low that technology will not be able to offset the amount of energy it takes to get it out of the ground and refine it. That is, I guess, the point where the mining companies, if you've already got existing production with higher ore grades, you might be able to do all right. But the new mining companies may not be as profitable as most people think. And I know a lot of people say, oh, the price will just go up. What I'm going to say here is, if that happens in a lot of different materials in the ground of Earth, and we get a shortage or a squeeze or a supply squeeze in energy, then every material shortage is just going to squeeze energy that much more. The choke point would be energy. It might not even be the material itself. Conversely, the material or the commodity owned outright could be the best investment, because the shortage and the want comes from the commodity itself, and it might not be from the energy required from it. So again, everything in this world is a derivative of energy. And the materials that are used to build all these different products are all derivatives of energy. And we use energy to put these materials all together. We weld them, we braze them, we assemble them together, we create rivets and screws and all these different things to affix each other, fix everything together. So I'm just making it apparent that sometimes the mining companies will not give you the leverage that you think you're going to get. That's all I'm saying. It says historically, investors are better off buying the dip than buying momentum. Since 93, owning the S&P 500 ETF SPY the day after red days generated a total gain of 740% compared to just 10% when buying after a green or flat day. So this is only owning day after up days, and you can see the underperformance versus only owning a day after down days. Much larger performance. Something I thought that was interesting. So it pays to be a contrarian and buy when things are down versus up. It says, one of the many charts I used to call the commodities bear market low back in 2020. When the second pink head and shoulders broke down, I understood the blue head and shoulders probably was for real. Orange support is holding at fib 50% retrace, and it is in timing band for the 3-year cycle low. He's talking about the price of oil. So this is crude oil. We've got a couple of things happening here. All right. We've got a shoulder, head, shoulder on a very large time frame that played out all the way to the downside. We also have on different time frames, shoulder, head, shoulder, shoulder, head, shoulder, that have also played out. We've broken the downtrend line to the upside, and then we've pulled back and have done a retest, a 50% retest off that broken downtrend line of this move from the bottom to the top and a 50% retracement. We've got the stochastics coming down to a very cheap level. And then we've got the MACD, and I don't use these. Some people like them. I don't really pay attention to them that much, but we do have higher lows, and maybe we're going to bottom here sometime shortly in the MACD. These are lagging indicators. I believe Michael Oliver calls them wet noodle indicators. I just think it's funny. But yeah, this does look good for a potential move higher. We may have a little bit more downside, get everything flushed out. I know the gap's been filled. I know some people are like, oh, there's a gap that needs to be filled. That gap's been filled. Now we got to wait to see buying pressure. If we see the pressure, I do think that we are going to go higher in oil. So long that we continue the fundamentals, which is a deficit in the supply demand, and we don't get dragged down by the overall markets in a recession fear or whatever it is, which is also a possibility. It does not mean that this can't go higher even if we have a recession. It can still go up. That is called stagflation. So it is possible. I'm just waiting for strength, and I'm talking about, to the members of what I said during the midweek update. I'm waiting for strength, and then it's game on if we can see some strength here. It says platinum followed silver and broke out big time on a weekly last week. Now back testing with big swings. These weekly breakouts should be good for their mega breakouts in the making on a monthly time frame. The long consolidations should be over. So this is the 2.5-year bullish expanding falling wedge. We've broken to the upside. We've come back to do a retest on platinum. Platinum on a ratio basis, cheapest metal against all of them. I'm going to continue to reiterate that when it is the cheapest. And we've broken to the upside here against the United States dollar. This is it, guys. This is it. And it looks fantastic. This is a great opportunity. Here's some investment wisdom. He says, you're neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Benjamin Graham. I get in a lot of arguments with people on the housing market, apparently. That is a very touchy subject. Everyone, it seems like, is bearish. It is by far the contrarian standpoint that we have a supply shortage in housing due to the demographic of the millennials and the reasons that interest rates are high, and the reason that we have unaffordable homes is because the demographic has priced it in such a way that the shortages of the housing market are so great that we have an unaffordable housing market, and that could continue to get worse or stay at very bad levels for a long period of time because of the mismatch between supply and demand. And I guess people do not want to believe that logic or narrative or however you want to call it. And again, if you disagree, it doesn't matter if you disagree. And I've had people say, oh, you're definitely in the minority. I don't care if I'm in the minority. It doesn't matter. It says you're right because the data and reasoning are right. Everything else, it doesn't. You could have 99 people out of 100 disagree with me. And if I'm right, I'm still right. It doesn't matter about consensus. It says Bernstein, even if electric vehicles equal 25% of total global car sales by 2025 and 50% in 2030, we will still consume the same amount of oil as we do today in 15 years, 2038. Where exactly is the required production going to come from? It says oil demand may still grow by 5 to 10 million barrels per day from now out till 2030 before entering a decline. That's 2030 that they're projecting. They've been wrong so much on when this thing's going to peak. There was people saying it's going to peak in 2022 and 2020 and 2021. Kathy Wood's coming out. Oil's never going to go back above $20 a barrel. Well, you know what? Cocaine's a hell of a drug. That's all I'm going to say. But I think oil is actually irreplaceable. I don't think we can replace it. Electric vehicles do not replace oil. The majority of electric vehicles are built out of oil. All the plastics, the paint, everything on that car is drenched in oil. I don't think we can drastically cut our oil consumption unless you drastically cut the population, and that population doesn't want to become wealthy. There you go. We've got winning streak continues. The physical uranium market continues to go up. That's a good thing. We've got Grady again. He says on lower time frames, the big breakout level for silver is $38 and $50. But using the yearly time frame plus closing prices, the neckline for the enormous cup and handle comes in very much lower at around $30 to $32, or $31 to $32. So we're getting pretty close to that neckline where we could potentially break the silver yearly. But in order for that to be valid, you'd have to close on the yearly candlestick. So when we come later this year, it's important to see if we are going above 31 or 32. And what he says, this is the mother of all very probable cup and handles. And this thing has been in the making since 1972. This is a massive cup and handle. The projected price move is 830% if you were to project it on top of $31 to $32. Big, big move there. It says apparently this was a bearish large inventory draw. Go figure. I just started laughing when I read this. We've got EIA weekly and oil products inventory report. Crude's down 5 million. Cushing flat. Gasoline's down 2.5 million. Distillates down 500,000. The SPR was drained by 1.1 million barrels. So he's like, apparently we've got this gigantic draw, and that is a bearish large inventory draw. Here's Eric Nuttall also talking about inventory. He says new record deficit for the U.S. Big Three inventories. Includes cumulative SPR releases. Recessionary fears are overwhelming fundamentals for now, yet we believe the magnitude of the summer inventory draws will overcome, leading to a powerful oil price rally. Patience. And there we are drawing back down again to massive levels below the 4-year average. Bank of America chart telling you to stay clear. You've been warned. Now, Bank of America looks like absolute garbage. we come up into this, we roll over here, and then we break the uptrend line, and then it's just see ya, wouldn't want to be ya. We've got the same setup here. This is also why I think we are seeing recessionary fears and potential fears in the market in general, is we've broken to the downside here, and we need to watch it. This is one of many bank stocks that look kind of crappy. I'm not saying they all look crappy, but there are a bunch of them that do look pretty crappy in the mixed bag of U.S. banks. Money supply is now down 4.1% year over year, the largest decline since the Great Depression in the 1930s. The Fed is doing something incredibly reckless here. And I agree, this M2 money supply going negative, this is huge. Look at how many times in history it's gone negative. None. Absolutely zero. So what are they doing with this? Is this money that is coming out from yield, or I should say QT, quantitative tightening? Is it coming out of financial assets and just coming off the books? But that money it's not being circulated in the money supply, it being exchanged in different hands. We are seeing the velocity of money kick up, but this is concerning that we've got a decline in the M2 money supply, like an actual decline, not a decline of growth, a decline literally going negative. So that's pretty crazy. Grady again. I think Grady's pretty good, guys. He's pretty on top of his stuff. The glorious commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. As I said for 3 years, do not miss it. Global capital has clearly started to flow from the stock market into commodities. So it begins. This is URA versus the S&P 500 on a weekly candlestick basis. You've got that big U-shaped pattern that is forming, and we're very low, very early in this pattern. This does not mean that it goes straight up. This means it's going to take time, and it's going to eventually work its way higher over time. Uranium will outperform the S&P 500. But that does not mean that it can't go down in the short term. This is a long-term ratio chart. So here is Tavi. He says, thus far, let me go into it first. Thus far, one of the key takeaways from this earnings season is that profits have begun to disappoint while revenues have remained resilient. This is a common trend during a business cycle downturn. According to historical data, changes in earnings per share tend to precede changes in top-line growth by approximately 1 quarter. Recent reports indicate that corporate profits have fallen by 13%. By comparing this trend to previous hard landing scenarios, such as the tech bust and the global financial crisis, earnings contracted by 71 and 54% respectively. There is a reasonably high chance of a similar macroeconomic event unfolding this time. It is evident that today's valuation of the overall equity market still does not factor in this significant risk. The current downturn started with one of the most expensive stock markets in history. So this is your earnings per share. We can see it's declining. It's down 13%. We've got revenues per share that are starting to come and roll over and decline. This is hard landing scenarios, and we are heading towards potentially a hard landing. That is why we're seeing interest rates drop to some extent. They haven't broken their downtrend lines yet, or uptrend lines. They haven't broken their trend lines, put it that way. But it could. It could very soon, and that's what we're watching for. This will have an impact on the pricing of commodities and everything in the market. That's why it's important to watch this. This is the recessionary fear that people have in the market. This is part of it. This is one piece of data of it. So that is something to watch. That's something that I'm watching interest rates, through interest rates, price all of this stuff. Here's Uselink, Casper. He says, last time we had this similar setup was just before a major black swan event come along in early 2020, where oil went negative. If we get spiky here, what do you think will be the cause this time around? And this is the platinum to crude oil ratio. Platinum broke out against crude oil. It ran very quickly against it, and it was also oil going down. And that was the kind of the three-headed kind of shoulder, head, shoulder, and the breakout. We've got another inverted head and shoulders, shoulder, head, shoulder, and a potential breakout of this ratio to move higher. That is what I'm talking about with the interest rates, the TYX, TNX ratio, how these things are moving. It is signaling that we could potentially have a problem in the market that is coming. And when we break these certain ratios, and we get outperformance of certain assets versus other assets, it's telling us that the market conditions have changed. We need to watch this. We need to watch it closely. We could see a problem in the market. Now, it hasn't broken out yet, but it sure looks like it's setting up to break out. So there could be some concern over the markets if we see interest rates fall, we see an uninversion of the yield curve, we see platinum break out against crude oil, and we see the continued weakness in revenues per share year over year. All of these things are telling us that we could potentially have a slowdown in the market. Does that for surely impact the price of oil, and are we going to go negative? I don't know about that stuff, guys. I don't know if we're going to have another 2020 type crash. I doubt it, but we could see a weakening in the market that does bring everything down to the downside. Here's another one. This is from Yelena. She says, new home sales, which are captured at the contract signing, popped 9.6% in March to the highest level since March of 2022. Home builders are picking up a portion of the slack left by an unwillingness to list in the existing market. So we could see new home sales benefit from a lack of existing homes. So that's also there. And that's where I'm going to end it there. So that's what I've got for today, guys. Hopefully you guys enjoyed the content. Give me a thumb up. Subscribe to the channel. Subscribe to the website if you're interested. We have a platinum question and answer session coming up 7 a.m. Mountain Standard Time on Saturday. And I have a discount. The coupon code's discount in the coupon code if you'd like to join and get a discount. All right, guys. That's all I've got for today. We'll catch you next time. This is Finding Value.